And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. So, we're going to talk about gold today, the miners. And I always like the miners because the miners, I mean, they're real companies rather than having a chunk of gold. But let's talk about what we see coming. Also, let's talk about the market. Why does this market seem like it's just dull? It seems like it needs a catalyst to move up or down. It's stalled. Well, that's because of the bond market. The one good thing about what we do in this business, we never have to wonder what the market's going to do or when's the market going to crash. We always got signals. And the bond market is really terrific because it tells us exactly what's going on. But first, let's go to the gold, and then we'll talk about the market. Now, gold miners have always been my favorite because they're real companies, and when you get great demand for gold, someone's got to get it out of the ground. So I've always done well with gold mining stocks and my gang members too. Now they're getting ready to trigger another buy signal. Now we're right at the point on the chart GDX. You can see on the chart GDX we're ready to break out. Now, and it's closer than we thought because of a few things. One, we have a weak dollar. Every time they anticipate rate cuts, we have these geopolitical tensions all over the world, especially U.S. and Iran. That uncertainty is really helping gold. And why is that? Because the central banks around the world are really buying. You know, they never stopped buying gold. When gold had that pullback, they didn't sell anything. And they're still buying. In fact, because of all this uncertainty with Iran and other countries, that they're going to, this year, beat their record year in 2022, where they bought 1,252 tons of gold. That was in 2022. They believe in this year, 2026, they're going to double that. Can you imagine? So it'd be wise to take a look at GDX and identify the buy signals. So if those buy signals kick in, that you're not going to lose out on a nice profitable trade, GDX. But you got to wait till the signal, kicks in. One thing we always know about the stock market, the market always does what it's supposed to do, but never when it's supposed to do it. Okay, now, so if you want to follow the same signals that we use and that we've been using since 1998, and I've been sharing them with my gang members, you're more than welcome to go to philsgang.com. Now, let's talk about what's going on with the markets. What you're feeling in the market is hesitation. Why? Well, let me turn to a chart and show you. Okay. So, let me just get this squared away here first, Willie. Okay. If you get to, all right. If you look at the 10-year Treasury yield, and if you remember, we talked about this, there's 10 institutions that have all the money, okay? They drive the market. They have the pool of money, okay? And so what happened in February, the hedge funds, out of the 10 institutions, only the hedge funds came in and started to buy treasuries. That drove us down to 3.95. Then they flipped and started to sell treasuries to push it back up. When it got at 4%, and you can see an imaginary line right here, I'll even snap it for you. This is a stabilization line. They look at this line as stability. But the problem with having a stability line, you got a real problem because the market's not going to do much. So if you look right here, that's the stability line. That's exactly where we are now at 4%. So again, when they go below 4%, the same hedge funds who are buying bonds turned around, started to sell bonds, push it up to 4%, and the other 9 institutions turned around and they started to buy bonds to make sure it didn't go up above 4%. Now why? What's going on? Well, the 10-year yield, as you know, is everything. And that's why when you're a good trader, good traders follow the yields. They tell you the truth. So there's hesitation. Now, it's not fear that we have going on here, but hesitation. Momentum is drying up. Now, most people get confused with momentum, okay, and trend. And I'll just show you on my chart again so you can see, so you understand what we're chatting about here. Right here. Trend is the price of your stock going up. This is the momentum. This is the momentum that keeps that stock up. Well, what's happening with the momentum now with the 10-year treasuries, they're just stalled. The momentum's drying up because institutions don't want to commit to buying anything or putting more money in. Like, for example, we've had some great stocks we've been working with. And I was going over that with my gang members today, where we made a lot of money on the industrial stocks, Honeywell, Caterpillar, FedEx, but they're all starting to go sideways now because so if you take any of the great industrial stocks we made money with, they're going sideways because the pool of money, they don't want to take and invest it because there's indecision. So the momentum's drying up until they figure out what's going on. And what do I mean by that? Well, there's indecision in the bond market right now because they don't know if yields are going to break to the downside, which would be bullish for stocks, or they're going to break to the upside, which is going to be bearish for stocks. So they don't know which way this is going to head. Now, institutions will buy stocks, okay, when there's clarity, but when there's no rate clarity, we don't know what rates are going to do, and the Fed's talking about cutting again. That's on the table. The institutions are not going to commit. So if you've been in good industrial stocks like Caterpillar and Honeywell and others, and they've been going up nice, and all of a sudden they're stopping, they're going sideways, this is what's happening, that the institutions that have all the money that push these stocks, retail people don't push stocks, they're not going to commit any more money. In fact, I was showing my gang today, and I'll show you on my chart. If you take a look, for example, at let's take a look at, for example, I can get them here for you, industrials. Now look at XLI. Now you notice how all of a sudden we're going sideways here. Well, first, we had nice pricing. Pricing was leading the way. Price equals trend. Trend was going up. And we also had nice momentum behind it. But now the institutions have stopped putting money into industrials. So we're going sideways right now. If you look at Caterpillar, another beautiful stock, see how it's going sideways? Industrials, institutions are not adding any more money to their Caterpillar. In fact, you can see it today when it opened up the first thing in the morning. Just first thing we look at is the opening pricing, and it couldn't hold its open high. It dropped right to a new low. So it's telling you institutions aren't adding to Caterpillar. Institutions aren't adding to Honeywell, and you can see on the pricing at 9:30, the minute they opened, they shot up. There's the high, there's the low. They broke the low, and so that tells you they're not. So all these wonderful stocks, FedEx, there's another one. Okay, they're hesitating now. UPS, again, they're hesitating now. Okay, so that's what you're feeling. So that hesitation. So who wants the yields to rise above 4%? No, banks, energy, industry. Okay, insurance companies, pension funds. They love high yields. Now you have, think about this way here, people who want growth, okay, like tech stocks, that's growth, okay, they want yields to drop below 4%. Value managers like banks, they want yields to break above 4%. So we're tied up right now that we're stuck right at that 4% in that stability area, and that's why the momentum has dried up. No fear here, just momentum. So so this is where people make lose a lot of money because they start forcing trades. They try to force them instead of pulling back. Now, housing market, everyone says is solid, right? But it's proving a little bit. Their mortgage rates went down today again a little bit, but we're starting to see housing improve a little. But we don't have the hot stock market, that's for sure. And buyers are really cautious right now. And when they're bidding on homes, they're real cautious. And it's hard to close a deal. That buying or selling frenzy, that's gone. But inventory is at least going up. That's good news. Inventory is going up, so you get more competition. New listings are up about 3.2% year over year. Not big, but it's at least up. Prices are flattening right now. The median listing price has dipped 2% year over year, the largest decline in over a year. And the mortgage rates have just eased, as we said, so that's going to help. So buyers have more negotiating power right now. So it's tough. If you're selling a house right now, you're going to get beat up. Now, the thing is, that's tied into that, the housing market, is the labor market. Now, we're always they lie to us about the labor market, okay? So the labor market's showing very low hiring, okay? There's very low hiring going on. There's very low firing going on. So what we're really seeing is stagnation, just like we're seeing in the Treasury at 4%. So we're seeing stagnation in the labor market. That doesn't help the housing market. And job growth in 2025 was extremely crappy. It was only 181,000 jobs. I mean, that was awful, job growth. And the unemployment, though, has improved a bit, just a little bit. Okay, it's ticking down just a tiny bit to 4.3. So it's down, but you wouldn't party this weekend over it, that's for sure. Now, job openings, there's the problem right there. The job openings are falling. That's the problem. So employers don't want to hire because that's the big expense. So they're not hiring, and so if you're a white collar guy, you're going to have a tough time. You better stay with your job. Don't quit until you get another job. So they're having a problem, especially because of AI. All right, now. So when they tell you this is a strong labor market, they're lying through their teeth. This is not a strong labor market. It's a stagnant labor market. It's not collapsing. It's not expanding. It's just like our yields right now, the bond yield, treasury yield. They're not going up. They're not going down. So this whole mood right now, everything's stuck. So when they come out and they tell you how great the economy is doing, it's all BS. This filters back to your stock market. So that's why now we're in this stock market. We don't have a catalyst to break out and run. We don't have a catalyst to sell short. So, and this is where a lot of money is lost because you try to force trades. The worst thing you can do is force a trade, okay? The other big problem they're having right now is that there's a lot of problems out there right now that's cutting off the liquidity to the market too. So be careful. Don't listen to the jibber jabbers. Follow the yield. That's always truthful.
Are you nuts?